Hello, there's me, Edward Ingram here, and here Pete. Pete is a property developer guy, and the guy behind me with the camera is an estate agent. And we're going to talk about the Ingram lending and savings model for housing finance. It's mostly going to be done on this paper here, and we're going to take the pictures from behind so that you can see what's going on. Okay, are you ready? Here we go. Now, this is a straight line which we could think would represent the average earnings of people if the average earnings of people never changed. Now that's not going to happen, but let us suppose for the moment that it's happening. Now the ordinary people, their incomes are doing something more like this. It's not, they average this, but they don't obey this. So when you're paying a mortgage, you don't pay your mortgage easily if the payments leap up and down, which is what they're inclined to do if you're using variable rates of interest. What you need to do is to have a mortgage payment scheme in which, compared with your average earnings, it gets easier every year, like this. Okay? So we've got a concept called national average earnings, or if you like, national average wages. And what happens is that you pay back the same amount that you borrowed in national average earnings plus some interest. That's how this model works. So you have to start higher than you would otherwise, and you finish up lower. Now that's quite common for people who take on a mortgage. If they're renting, they will normally take about 21% of income. If they're borrowing, they will normally take about 30% of income. But that 30% drops as wages or national average earnings increases to maybe 11% at the end of 25 years. So 25 years. So that's what we would like to happen. But for that to happen, we would need wages to be growing at 4% per annum, like this. Okay? And we would need the cost of your interest to be fixed, like this, so that this distance is always 4% per annum. 4% per annum will give you this from there to there.
Let's make it 34%.
30% of income, falling 4% per annum compared with average incomes or wages until it reaches 11% of national average earnings or wages.
Okay, just explain to me, if the interest going up and down, you got an income,
Yeah.
and you got to pay back on that house mortgage.
Yes.
Am I right?
Yes.
So the interest is going down or up.
Yes.
What's happening with
the interest?
With the interest.
Well, that's a very good question. Now, we looked at the interest charged compared with the rate of increase of national average earnings. Now, we've got to call that something. So we call that average earnings growth, % per annum. And what we find, before I come to answer your question, what we find is that if wages were to rise by, shall we say, 10%, then if mortgages don't cost more, the number of years' work that you need to repay the number of years' income that you've borrowed would be 10% less. You'd pay off your loan 10% faster without doing any extra work or any extra income compared to what you were doing anyway. So if you want to preserve for the lender the number of NAE that you've borrowed, then they will have to add 10% interest to your loan, which is, in this case, equals to average earnings growth for that year. So we looked at South Africa, the UK and Japan, and we found that the amount of interest that was charged over and above this averaged out at 3% in every case. It was going up and down, but the average was 3% over the longer term. And so what we are looking at now is how can we cope with this thing and average out at something like that. And why would there be this average figure? Well, because if the economy is going too fast, then the central bank raises the interest rate. And if incomes are rising faster, they have to take that into account as well. So it's AEG plus this bit. And this bit could now be 4%. Or in actual fact, on historical data, it could be something quite wild, but then it shoots back down again, wildly in both directions. But if we have a nicer run economy, it won't be that wild. What we're trying to do is to create a nicer economy. But we still have to cope with the economy as it is, which we've done tests on this new model, and it's okay. So what they do then is the economy slows down too much, so they reduce this figure, and then the economy goes up. And so you get this average. So we know that there's an average figure, and we know from historical data approximately what it is. That's not in every country, because some countries have more risk of lending, more risk of unemployment than others, and they have to cover their risks. So that's another story. But what I want to do now is I want to show you how we worked out the starting cost for such a mortgage. It's called the entry cost. What is the entry cost? Well, now we're going to have to draw a diagram. Not everybody is a good mathematician, but don't worry, you don't have to be good at maths to understand this. Let's put this figure here, P% per annum. That's your payments as a percentage of your loan L. Okay, so you've got a loan of 100 and you have interest added of R%, or shall we say 7%, and you've got payments of 7%, and you end up with 100. That's what's called a standing loan. So here we are, there's R% there. And what you've done is you've paid R%, and your loan is neither greater nor smaller than it was at the start of the year. But let us say that your payments are not fixed, that there is a thing called escalation. Now, escalation means like your wages are rising, escalating compound every year. And let's say that your payments and your rental payments, for example, are also escalating. Question is there this gap between the two? Now, first of all, we need to know what is a standing loan. So I'm going to draw a dotted line here, which is average earnings growth, because that is a % per annum in the same way as this is. And we want our payments to be less than that, don't we? We want the payments to be less than that. That's this gap here. So we want them to rise, maybe, or fall, maybe, but we want them to have this gap. If incomes are falling, we want them to fall faster, like that, but we still want this gap. Now, supposing that we don't pay 7%, we pay 6%, then L is equal to 100 plus 7, the interest hasn't changed, minus 6, and we end up with 101. So the loan has risen by 1%. If we are going to have a standing loan, then we now have to escalate the payments for next year so that they are 1% bigger, so that the mathematician thinks it's a new loan, it's just 1% bigger, and the payments are 1% bigger, and everything is reset to where it was in the first place. Now we can draw that on this graph, like that. That's 1% less, and it's 1% along this direction.
Okay, can we just go back a bit?
Yeah.
Just explain it to the person that doesn't really understand. Can you just put it in a more, what do they call it, a way to understand?
Well, that's what these numbers are here. You can get a standing loan in this way, and you can get a standing loan in this way as long as your P becomes, as long as your payment 6 rises by 1% at the end of the year for the next year, because the loan is 1% bigger. So you've now got P, your original P plus 1%, and you've got your original loan plus 1%, and it's the same as before. You've still got P over L is standing still.
Just go back. This is the average guy. That is his salary.
Yes.
And he is loaning over 25 years.
Yes.
So he's got to say the economy is about 7% loan out.
That's the interest rate.
The interest rate.
Yes.
Right. This guy is paying an interest rate, and the bank worked out a specific installment for him. Right?
Yeah.
Am I right? Now to come back, if that guy get an increase, as I can say it, and he's prepared to pay, say, 1% more than as the bond.
Yes.
Just explain that.
Well, that's not what we're talking about. We're talking about the condition where there's a standing loan. The guy is paying only interest, and the interest isn't changing.
Okay, so the interest, so that is, he signed up for a loan percentage. Am I right?
We're saying that he's got a loan of 100 or 100,000,
Yeah.
but the interest is 7,
7%.
and he's paying 7.
That's
So he ends up with 100 at the end of the year.
right. Okay.
Now, okay, so we can do that at 2% as well as 1%, and you'll get a loan that's 102, and you'll increase by 2% here. So this is now 2% increase at the end of the year. You can do it for 3%, 4%, and you can do it for 7% down here, which is where you started It's a right angle triangle. For every 1%, you come down from 7%, you move 1% along, so that's 7%, okay, or R percent.
Yeah.
Now, how high is this? We know that we've got to be paying off the loan, so we know that we've got to be above this line. Otherwise, you're not paying it off. So that figure there is C%. Now we know this figure here is, let's call it D%. Let's draw that again, here. So that's D%. Now we know that this side is equal to that side, so that side is D%. Now this side here, that's AEG and that's R. This distance is R% minus AEG%. That's that distance, which we're going to call I% for marginal rate of interest above AEG. So this is I%, and this distance here is I%. So how high is that? That is P% is equal to C% plus D% plus I%. How neat is that?
100% works out.
That's amazingly
Yeah, that works out, because yeah, you can see the difference over there,
yeah.
and yeah, it's going up on a 25% base, and then you've got your 7% over there, or your 6%, whatever it is.
Now scientists love something that's really simple. It tells them that they've uncovered some kind of truth.
Yeah, this is simple,
Yeah.
and it makes sense on the end.
So this is the equation that governs the Ingram Lending and Savings Model, ILS model, for mortgage finance. And what we say is, what is the average figure for this? Well, we know it's about 3%.
That's only
Yeah.
3% base.
So we put 3% in there. Now, if the interest rate rises to 4%, we don't want to disturb this, so this one will come down 1% from 4% to 3%, and well, it starts at 4%,
Yeah, it starts on 4%.
and then if this rises to 4, that comes down to 3, and then C% doesn't get affected. But if you were to have a really extreme change in this, if you really got it badly wrong, then this would fall to 0 and this could fall to 0, and you'd have basically a loan that goes on forever. But these are your safety margins here. That's actually 1.5% to pay it off in 25 years. So P% is equal to that, that plus that plus that.
Plus that.
That's 7,
That's your
8.5%.
That's your 4, 3 and a 1.
Yeah. So P% is 8.5% on this model. And on that model, you can borrow 3.5 times income.
The amount of income.
Yeah, that's how much you can borrow.
Because
Now-
you've already got your standard over there.
Yeah. Now you notice that it doesn't contain AEG. Everything is related to AG. You can hide that, and the equation is still the same. It's still I% plus D% plus C%. And you don't know what, all you know is that it's related to AG. So this doesn't have to work just in South Africa. It can work in the UK, and it can work in any country, provided they've got some kind of decent control over the economy. And so what does this mean? This means that the amount you can lend doesn't go shooting up and down when the interest rate changes.
This is actually a saving on a 3.5.
This is how much you can borrow.
Yeah.
Yeah. So this means that if you're building houses and you want to know if the property price is going to be stable, you want this number to be stable, which it very much is, even if inflation goes up and down. And even if the central bank changes this number, then you can change that number to keep this fairly stable. It just means people have to work harder to pay off their loan after that. And so they'll be less inclined to borrow. But instead of having the construction sector going up and down, throwing people out of work, we'll have them more or less permanently employing people, permanently building houses, and the whole economy will stop being cyclical, driven by this sector, because the housing sector is about 15% of the economy, and the support like furnishings and drainage and all the stuff that goes with it, loads, that brings it up to about 1/3 of the economy. To have 1/3 of the economy jumping around because of the mortgage model, which changes this number all the time, that's a nonsense. And that's what we've got to get rid of. So if we do that, then the whole economy will grow faster, more continuously, they'll have more houses built. How do you like it?
That's 100%. It works at 100%. I think everybody will understand what you're trying to explain to them, and I think it will work.
And what's more, we've done tests using a spreadsheet on all kinds of past data, and it does work. Even in an unruly economy, you can put one of these things in and make it work. But what will happen is the lenders that continue to use the existing model will lose market share to these guys because they are safe.
Yeah.
There's various tax and other problems that the government has to address. So we're offering this to governments on a consultancy basis, if you like on a franchise, so that we can oversee what they're doing and make sure they're doing it right. Thank you very much.
Thanks very much. I explained it 100%. Thanks very much.